Hello, this is Mijun from Mayib Siren University. Let's start today's Mayib Siren news for September 10th. Welcome once again to Mijun, where we consistently uphold the fundamentals of investing in United States stocks. After moving to Malaysia, on Tuesday, Wednesday, and Thursday, I have a bit more free time. Because the kids finish school very late on those days. Yesterday, I shared my family's morning routine with you. The kids swim at school before classes start, and then school ends around 3:10 in the afternoon. But in my kids' case, they do extracurricular activities every day. The school offers something called co-curricular activities, which are club activities. It's kind of like a club, and the cost is almost free. So it's for 1 hour every day. Now, my son really loves sports, and my daughter really enjoys art and making things. So, according to their preferences, from 4:15 to 5 o'clock, they spend time doing these special activities and hobbies. But on Tuesdays, Wednesdays, and Thursdays, we take it a step further. So, they don't come home at 4:15 instead, they start swimming at that time. On Tuesday, Wednesday, and Thursday, they swim once in the morning, and then after school, they swim for another hour and a half. So by the time they're done with swimming, it's 6 o'clock. So after sending the kids to school in the morning, my wife and I have a really long couple time until 6 post-meridian. So lately, whenever it's Tuesday or Wednesday, I feel more at ease. And since my wife and I have more time together, I think the quality of our life is improving. Then when the weekend arrives, the kids wear us out again. But a lot of people around me have advised me to spend more time with my kids while they're still young and to enjoy today. So during the weekends, I'm trying to spend enjoyable time with my kids. Alright, since my kids have swimming until 6 o'clock today, I think I can do the broadcast a bit more comfortably. Let's get started with today's big news prepared for September 10th. Many questions were left by our valued subscribers today. And one of those questions really resonated with me, so today I'm thinking of structuring the broadcast based on that question. In the middle of the broadcast, I'll read that comment to you and try to provide some answers. Alright, first, let's start by going over the United States stock market situation from yesterday. You're looking at the map of the S&P 500, and even at a glance yesterday, it was a mixed market. It looks like about half went up and about half went down. Small cap stocks dropped a lot while many of the major stocks showed a positive trend. Especially among the so-called Magnificent Seven companies, except for Apple, all of them closed in the positive. So we can infer that the overall index situation wasn't bad. If you look at the indices that rose yesterday, Dow Jones. Dow Jones is a collection of 30 blue chip companies in the United States. It rose 0.4%, the best performance. Second, the Nasdaq 100 rose 0.28%, and the S&P 500, a group of 500 blue chip companies, increased 0.23%. On the other hand, small cap stocks fell for the second day in a row, dropping by 0.87%, which is a relatively large decline, and mid cap stocks also plunged by 0.91%. Now, if you look at it this way, you can see that market participants are really smart just by looking at the movement of the indices. There are two notable situations recently. One is that the possibility of interest rates falling is very high, so it's a bit of a shame to stay out of the market. Cutting interest rates usually boosts the United States stock market, making it hard to avoid investing in stocks. But if you look at the other side, the economy is slowing down, so there's anxiety about the economic slowdown. So what investors have found as a solution is to invest in somewhat safer stocks because it's a market that's too good to leave and interest rates are being cut. At the same time, there are big risks since there's the risk of an economic slowdown. Money is shifting to safer stocks. In this way, the market yesterday and the day before yesterday are showing the same pattern. But the market sentiment hasn't changed much, and there wasn't much change in the breadth of the market yesterday either. About 56% to 66% of stocks are showing a good short-term trend right now, and the number of stocks with a good long-term trend is still close to 62%. Next, looking at the volatility index, market volatility index, it's the same story. At 15 and 11, it's still maintaining a very calm state. As I've mentioned many times, when the volatility index maintains such a calm trend below the 201 moving average, it's very positive. A quiet market is typically one that rises steadily. So you can see it as the Goldilocks situation still continuing right now. Next is the fear and greed index. There hasn't been much change. It's staying neutral at 50. Let's take another look at the fear and greed index with a graph this time. That way, the market situation becomes a bit clearer. As you can see here, since mid-May until now, this fear and greed index has been stuck in a box range. When it went up, 75 was the maximum. Whenever it reached 75, it inevitably dropped. Also, if you look at the bottom here, you'll see it was at 54 to 55, and the lowest it dropped was 50. So right now, you can see that it's in a sideways trend, stuck between 50 and 75. Now, if the fear and greed index is stuck within this range, that's actually very welcome news for us as investors. It's a sign the trend is holding steady. But on the other hand, if it suddenly shoots up past 75 and becomes overheated, then anxiety starts to set in. On the other hand, if it drops below 50, that's not good either, because if the fear and greed index falls out of the box range below 50, that means the market sentiment has turned cold. You could see it that way. Now, we've arrived at a very important point. That's because we've come down almost to the bottom. Since we've reached the bottom of the box, what's most important now is how the stock price moves over the next day or two. That's how you should see it. Now, this week, what's important is whether the stock price shows an upward trend again within this box range or breaks downward. As I mentioned yesterday, on Wednesday, September 10th, the United States Bureau of Labor Statistics will release the Producer Price Index report for August. Today's Producer Price Index forecast shows a headline increase of 0.3%, while the more important Core Producer Price Index is also under close watch. This is calculated again, excluding food and energy. It's called the Core Producer Price Index, and this is also starting at plus 0.3. Compared to last year, the overall Producer Price Index is expected to rise by about 3%, and the Core Producer Price Index is projected to increase by around 2.9 to 3.0%. It would be good if this figure stays the same. If a much hotter Producer Price Index is reported that far exceeds this, the market could be somewhat shaken. That's how you should see it. And it's released tomorrow. No matter how much I emphasize it, it's never too much. Even our efforts will increase. Like Quince, there was something important that happened yesterday. As expected, the market rose again due to bad news. Let me briefly explain what happened. It was quite low. It appeared these kinds of headlines are being reported. Now, what this means is, there's the United States Bureau of Labor Statistics, which we call the Bureau of Labor Statistics every month. They conduct employment surveys. But since there is a possibility that this could be wrong, they review it and update it. So yesterday, the first update was announced. Employment increased much less than expected. On Tuesday, the United States Bureau of Labor Statistics released net employment growth for the 12 months ending March 2025. They announced that the figure was reduced by 911,000 compared to what was previously reported. What does that mean? Originally, it was reported that about 1.8 million jobs were added over 12 months, but in reality, it was only 847,000 according to the announcement. The United States Bureau of Labor Statistics, or Bureau of Labor Statistics, counts jobs every month, right? The United States makes benchmark revisions to align the time-lagged current employment statistics with the more comprehensive quarterly census of employment and wages, Now, the revised figures were released yesterday. The figures turned out to be much lower than what we had expected and what we had believed until now. Therefore, it can be understood that the economy is slowing down much faster than we thought. However, the latest update reflects figures from several months ago and is not final. The final figures will be announced in February 2026. That means next week, the Federal Open Market Committee meeting will be held, but due to the impact of these figures, the possibility of a 0.5 percentage point rate cut is still not very high. So, as planned, it will probably only drop by 0.25% as the market expects. That's what they're saying. However, even so, if we interpret the figures announced yesterday in a positive way, it could serve to strengthen the argument for consecutive interest rate cuts. This suggests there will likely be at least 3 rate cuts by year end, not just one in September, with cuts continuing into next year. That's why, after yesterday's bad news, the United States stock market trended upward again. Now, there's one thing we need to be careful about here. United States stocks are climbing as people expect the Fed to lower interest rates. If inflation accelerates again, then all of that will be for nothing. So inflation is extremely important. All right, let me wrap things up with a final word from me. With the recent revision of the employment data, the importance of the Producer Price Index and Consumer Price Index to be announced this week has become greater than ever. Until now, the market has been used to a structure of strong growth and persistent inflation. Persistent inflation is not a good thing, but the reason inflation hasn't been a problem is because strong growth has continued. Because the economy was solid, the Fed had no reason to rush to cut interest rates. So you can see it as having the leeway to focus on inflation. The market's interest was in when inflation would be brought under control, because interest rates are very high right now. So people were expecting that it's only a matter of time before inflation is controlled. So what that means is the market was leisurely enjoying a sort of Goldilocks situation. That's how you can see it. However, the recent major downward revision of employment data has made the slowdown in growth clear. And another thing, inflation is still uncertain. So from now on, we've entered a new phase. Growth, a key economic pillar, has been confirmed as weakened. Now that one thing is certain, the other also needs to be, but what's the issue? There still aren't clear signs that inflation is under control. Now, if inflation also turns out to be high, and if the economy worsens while inflation rises, we'll be facing the worst case scenario. Because a weaker than expected job market is a signal that interest rates need to be lowered to stimulate the economy. But if prices start to rise again, it means that tightening needs to be maintained or even strengthened to control inflation. Interest rates may need to be raised rather than lowered. So, in conclusion, confirming this slowdown in employment means that the importance of inflation indicators should be raised even further. Alright, therefore, if today's Producer Price Index and tomorrow's Consumer Price Index come out stronger than expected, then the market, previously confident in a soft landing and Goldilocks scenario, will shift from that view. There is a possibility that the risk of stagflation will be seriously reflected in prices, so this can be interpreted negatively. At the start of the broadcast, Recently, investors in the market have been flocking to stocks that can withstand an economic slowdown and also benefit if interest rates fall. Here's my summary for you. Artificial intelligence beneficiary stocks are a prime example of those that can benefit from falling interest rates, even during an economic slowdown. And another one is Bitcoin beneficiary stocks, because Bitcoin isn't really related to the economy. However, when interest rates fall, the value of cryptocurrencies like Bitcoin can rise because their valuation goes up. So that's why Mijuan's top picks were really good yesterday. Mijuan's top picks are basically made up of artificial intelligence beneficiary stocks and Bitcoin beneficiary stocks. Now, if you look at the performance of Mijuan's top picks, yesterday, Coinbase jumped 5.49% for the first time in a while. Second, Palantir rose 4.01%, Vistra Energy 3.07%, Advanced Micro Devices 2.91%, Alphabet 2.39%, Meta 1.78%, Talon Energy 1.55%, Taiwan Semiconductor Manufacturing Company 1.51%, Nvidia 1.46%, Credo 1.02%, and even Tesla gained. It rose by 0.16%. If you look at the stocks that fell yesterday, Bitcoin moved sideways. It's at 111,470. Pearl Solar is down 0.07, Celestica down 0.10, Strategy down 0.42, Astera down 0.75, and B2 down 1.36. Lastly, Broadcom is down 2.68%, undergoing a technical correction. But even yesterday's stocks in the red still benefit from artificial intelligence or Bitcoin, right? Therefore, in the futures market, all of them are showing a sharp upward trend. I can share this good news with you all. Of course, these artificial intelligence beneficiaries and Bitcoin beneficiaries, right? Depending on the inflation data released today, the direction can change at any time. You need to remember this part. Now, let me explain the main article that I will be sharing with you today. Mijuan and Top Pick are mainly artificial intelligence or Bitcoin beneficiaries, as you saw earlier. Now, there was a very wise investor who pointed out the risks regarding this, so I'd like to read this person's feedback and comment. This is a post left by Choi Jin Cheol. Hello, I am a long-time subscriber living in the United States. It's great when the market is good like now, but the time when Mijuan was the biggest support for me was actually during the COVID era, when the market was really bad. On other channels, everyone was just complaining. Mijuan always supported us with a positive yet cool-headed attitude, sticking to the fundamentals of investing and keeping to his principles, and seeing that helped me get through tough times as well. Mijuan shines brightest in tough times, always cheering for you. Since then, I've also been investing in artificial intelligence, related stocks based on momentum, similar to Mijuan, and have been seeing good results. Recently, as I look at our investments, I'd like to share some of my thoughts and concerns that I've organized in my own way. If there's anything I've misunderstood, I'd appreciate it if you could let me know. From what I see, I think you're talking about our strategy, the Mijuan strategy. The biggest advantage of the Mijuan strategy is that it consistently rides the big wave of the artificial intelligence supercycle. You've placed us in key GPU and accelerator companies, as well as throughout the infrastructure, supply chain, and networking, demonstrating clear direction. And it's also very impressive that you maintain about 10% to 20% in cash-keeping flexibility even during downturns, and leaving the option to re-enter when necessary. I was also impressed by how every decision has a reason, and you always maintain that discipline. However, to be objective, there are definitely risks as well. As companies pursue artificial intelligence, a lot of capital to build artificial intelligence infrastructure. So we're talking about the stocks that benefit from this. Because these companies are tied to the artificial intelligence capex cycle, if artificial intelligence demand slows down or customers delay their capex, they could be hit all at once. Also, the companies favored by artificial intelligence leaders tend to rise quickly, but when they fall, the exit is narrow, so there's a crowding risk. Even a single earnings report or regulatory news can cause a gap down of more than 20%, and how to manage these event risks in advance is still a concern. Above all, for high-income earners in the United States, the tax burden from short-term trading feels like it's almost 40%, and this seems to be the biggest friction in investing. No matter how much your annual returns outperform the S&P or QQQ when you calculate the after-tax performance, it can be less attractive than you might think, and that's something that bothers me. Mentor Nim, it seems like you focus more on the profit curve itself rather than taxes, but I can't shake the thought that, in the long run, taxes are the biggest risk that hinders the compounding effect. It's like pouring water into a jar with a hole in it, you know? Mentornim, do you still feel the same way about after-tax performance? There were a few more things said after that, but since it's too long, I'll stop reading here. So, in today's broadcast, since a subscriber left such a thoughtful comment, I also did my best to put together an answer as an article. Let's read it together. Hello, Choi Jin Chol. You've been watching since 2020, and especially during the difficult times of COVID-19, you said you gained strength through my channel. As the operator of Mijuan, I feel an immense sense of pride and joy. Your words that we shine even brighter in difficult times are truly touching. I will keep striving to be an investor who upholds my principles and stays true to your words, so I won't be ashamed. Now, since you've asked such an amazing question, I'd like to give you an answer to it. I am also aware of the risk factors you pointed out. There are three types. The first is the artificial intelligence capex cycle concentration risk. The second is the crowding risk. Now, the crowding risk is we're investing in leading stocks, creating a concentration effect. So, because of this, I think we just have to accept the high volatility. It's like two sides of the same coin. The stocks we're investing in could suddenly drop by 10% or 20%, but for that reason, these stocks could also suddenly go up by 10% or 20%. If you invest in stocks that don't have the possibility of dropping by 10% or 20%, those stocks also don't have the possibility of suddenly rising by 10% or 20%. I hope you keep this in mind. Now, for the third point, you asked some questions about the tax burden. So today, among these, I've organized my thoughts on the risks related to taxes and the artificial intelligence capex cycle. First, let me briefly explain about taxes. To be direct, I believe it's best not to get too involved in tax issues. I believe that focusing more on maximizing long-term investment returns is more effective. Especially recently, this belief has become even stronger because I've reached a point where I need to manage my physical stamina. In the past, to put it simply, I used to work more than 15 hours a day. From 2020 to 2023, honestly, I worked 15 hours a day, sometimes even 16 hours. But recently, even working 10 hours a day has become difficult for me. What that means is the energy and time I can use are limited, so I have to decide what to focus on during this time. Now, of course, taxes are a very important expense. However, missing the best time to sell, giving up higher profits just to avoid taxes, or not paying attention is not the right approach. It could end up costing you more than it's worth. I still believe this. For example, even if you have to pay a high tax rate of 40%, making a 100% profit is much more advantageous for growing your assets in the long run than settling for a 10% profit just to avoid paying taxes. So there's something I've been telling you for a long time. I don't really pay much attention to the rate of return. What's important to me is this. I focus only on how much the money in my account is increasing right now, whether I have more today than yesterday, more now than a week ago, and how much it's gone up compared to a month ago. I also have a target for my rate of return. My goal is the return rate of the Mijuan portfolio. The goal is to beat the S&P 500 by at least double. That's the minimum. So the S&P 500 usually goes up by about 10% on average in the past. So what I'm aiming for is to achieve at least a 20% return. I want to emphasize again that this is my target rate of return. And in my opinion, I believe that in order to achieve such high goals, it's more important to consistently make the best investment decisions, even if it means sometimes accepting higher taxes. However, that doesn't mean that I'm completely ignoring taxes. I also naturally manage taxes as I operate my portfolio. What I mean is, for example, I regularly replace stocks in my portfolio and adjust their proportions. Sometimes there are stocks where the momentum slows down or my confidence in the fundamental analysis weakens. At times like that, as you all know, I'm really good at cutting my losses. Now, the capital loss that occurs like this is used to offset the capital gains from other stocks in the portfolio. I also take profits quite often because when the momentum drops, I sell stocks that have gone up. Since I frequently cut losses and take profits, my gains and losses overlap each year, resulting in minimal taxes. That's how it works. For example, if I made a $10,000 profit from stock A but took a $5,000 loss from stock B, my taxable profit would drop to $5,000. Since I rebalance my portfolio year-round, locking in losses is almost an annual routine. Let me sum it up by saying that this effectively lowers the overall tax burden. And also, when you generate profits like this every year, you know you have tax deductions, right? In Korea, it's around 2.5 million won. So because of these deduction benefits, I personally think it's very important to realize some profits and also realize some losses every year. Now, after that, I personally think this second risk is a much more important topic. Mijuan's portfolio is mostly concentrated in artificial intelligence beneficiary stocks. There are some Bitcoin beneficiary stocks, but they make up a much smaller portion than artificial intelligence beneficiary stocks. So, whether artificial intelligence does well or not, our portfolio's returns will be determined by that. Now, I'd like to honestly share my personal opinion about this. I think this is probably the first time I'm talking about this on air. That's how good the question was, so I think this is a good opportunity for me to honestly share my feelings. Next, I'll discuss the risks of concentrating investments in artificial intelligence beneficiary stocks, an even more important issue than taxes. As Choi Jin-cheol noted, the Mijuan portfolio appears diverse on the surface, holding up to 18 stocks. But in the end, except for Bitcoin, They're all tied to the same artificial intelligence capex cycle. So as you were concerned, if demand slows down, there's a possibility that all of them could be hit simultaneously. I'd like to say that there's a very reasonable logic behind this. Now, there's something else I'd like to tell you here. What I'm worried about is actually the exact opposite. Let me explain what I mean. What worries me most about investing in United States stocks is this. What if the development of artificial intelligence progresses so quickly that society can't keep up? I'm worried that it might eliminate a huge number of existing jobs all at once before new jobs are even created. That's the concern I have. It's obvious that companies around the world will compete to replace human labor with artificial intelligence and robots in order to maximize productivity and cost efficiency. Companies have always aimed to maximize their profits. Therefore, it seems very easy for people's jobs to disappear. Now, here's the problem. If the speed of technological advancement becomes so fast that social and institutional safety nets can't keep up, this could become a major social problem. Now, if this happens, even if productivity and efficiency of companies increase dramatically due to artificial intelligence, there will still be mass unemployment. If that happens, the majority of consumers like us may lose their purchasing power. Now, if that happens, no matter how innovative products and services companies produce, the market itself that would consume them could disappear, or the size of the market could shrink dramatically. If this situation becomes a reality, then ultimately companies' performance will inevitably worsen, and the stock market will also inevitably fall into a long period of stagnation. This is the scenario I'm worried about. So, in conclusion, we need to pay attention to both extremes of risk. First of all, there's the risk that the artificial intelligence revolution could end prematurely. As Mr. Choi Jin-cheol was concerned, investment in artificial intelligence might not last as long as we expect, and the anticipation could fade. If that happens, stock prices will fall. Now, the second risk is something I'm worried about. It's an artificial intelligence revolution, but if artificial intelligence succeeds too quickly, the artificial intelligence era could arrive much faster than we expected because things are moving so rapidly. If that happens, we could see scenarios where there is social collapse or at least a destruction of demand. So, we need to keep these two things in mind when investing. These are the two main risks of artificial intelligence. Here's my view. As I always say, the future can't be predicted with complete accuracy. So, we don't know how long this steady upward trend, the Goldilocks zone, will continue. Therefore, what we need to do as investors is this. Instead of blindly believing one scenario, we should consider both possibilities. We need to continuously monitor real-world data. Is the economy actually slowing down? And how much is the job market cooling off? Because what I'm worried about is that this employment safety net might suddenly drop sharply. If artificial intelligence takes away all the jobs, there's a possibility that something like this could happen. Therefore, in my personal opinion, it's very important to pay attention to the news to understand what's actually happening in the market. That's the only way we can respond flexibly based on that information. Let me repeat. In stock investing, don't predict, respond. So, you need to closely monitor things like changes in employment indicators, the direction of social policies, and the pace of technological adoption. It's impossible to pinpoint exactly where the peak of the artificial intelligence supercycle will be. So what we need to focus on is the industry itself. When will the artificial intelligence beneficiary stocks we're investing in reach their peak? We should identify when they fall by 10%, 20%, or 30% and act then. Our goal is to effectively realize the profits we've made so far, and that's the core of our journey in investing in United States stocks. I'll wrap it up here. All right, today's broadcast. Let me introduce the last content of today's broadcast. Today, we've prepared a dubbed video. Today's video is about United States stocks, and in today's United States stock video, Michael Saylor appears. He's the Chief Executive Officer and founder of MicroStrategy. Earlier in today's broadcast, I explained the risks of investing in artificial intelligence in detail, so I think we've talked enough about artificial intelligence. Now, let's turn our attention to another part of the United States portfolio, Bitcoin. I'd like to listen to Michael Saylor's thoughts on the future of Bitcoin. That's all for today's United States stock news. If today's broadcast was even a little helpful for your investment activities, I'd really appreciate your valuable likes and lots of comments. And if you have any thoughts you'd like to share or any questions, please leave detailed questions and I'll do my best to provide detailed answers as well. All of us in the United States Let's keep working together until we retire through stock investing. Have a great day. Thank you. This morning, Bitcoin.
Let's check the price. Cryptocurrency has more than doubled since the start of the year. Joining us now is Bitcoin bull Michael Saylor, chairman of MicroStrategy. Tom Lee was on the show this morning. I'm not sure if you saw it. He said that Bitcoin is currently at $111,000, but that it will reach $200,000 by Christmas. What do you think? Most of our stocks...
The stock analysts who track our stocks are setting the Bitcoin target price at over $50,000. Bitcoin represents the digital transformation of the capital market. As more people learn about Bitcoin, learn more about it, and more companies adopt it, the price will continue to rise. No more Bitcoin can be created, so by year's end, Bitcoin will hit $200,000.
I'm curious what kind of movements you're seeing right now in terms of capital inflow or market trends for Bitcoin to reach that level. Yes, the capital from ETFs.
The inflow is very active. BlackRock is showing record-breaking numbers. Our company also raised $19 billion this year, and all the funds went into Bitcoin. This morning, right before coming here, we announced a Bitcoin purchase worth $217 million. Today, $217 million, which is just a little less than 1,000 Bitcoins. When we became the first publicly traded company to buy Bitcoin, we purchased $50 million worth. That was all the funds we had accumulated over 30 years. But this purchase was made in just 4 days. So let me ask you this.
Is that okay? Should we see investors who invest in the strategy as not directly investing in Bitcoin, but rather as making a leveraged bet on Bitcoin? That's right. The price of Bitcoin
goes up.
It must be really fantastic because it doubles. But what happens if it goes down, if a bear market comes? Many investors
have to buy stocks, so we offer stocks based on Bitcoin. And some investors need to buy shredded. We have 4 types of credit products and preferred stocks based on Bitcoin. Investors who want exposure while reducing risk by credit products like Strike, you can maintain upside potential while also having some downside protection. On the other hand, investors who buy stocks want double the effect of Bitcoin price fluctuations. In the end, 99% of the world's funds are allocated to stocks and credit. Most professional investors and the majority of passive funds can't directly buy the underlying asset called Bitcoin, even if they want to. But as I understand it,
what I want to understand is, even if a crypto winter comes, the reason we call it a winter is because there's a possibility that summer will come again. At what level, at what price range, does the situation get complicated enough that we actually need to start selling? Now, about leverage.
You could say I have a PhD in it, and that's because I personally went through the last crypto winter. At that time, Bitcoin moved from $6,000 to $16,000, and we even bought in when it was at $16,000. Previously, we used senior bonds and margin loans, then moved to convertible bonds, and this year started restructuring with preferred stocks. Preferred stocks are the best form of leverage because they have no maturity date. So I don't think there's any major problem right now. Our leverage essentially comes from preferred stocks, not from debt. In the morning, it's tied up with its SUI.
You said you bought $7 million worth. Then, what is the total average purchase price for Bitcoin so far? In other words, what is the average price in dollars? It's about $73,000.
Holding a large amount of Bitcoin.
Do you think there is still a bias from indexes or other institutions against companies that hold Bitcoin? Holding a large amount of Bitcoin.
Do you think institutions are still biased against companies? Do you think indexes or institutions are still biased against companies that hold a large amount of Bitcoin? What I just mentioned.
Can we revisit the preferred stock section? People may want more information. You called this a leveraged bet, but as preferred stock, it has no maturity date. How is it possible for there to be no maturity at all? If you use margin loans,
you probably wouldn't want your leverage to exceed 10%. Using bonds, the limit is likely 20-25% max. But if you issue a perpetual instrument, for example, if I borrow $1 billion permanently and agree to pay a 10% annual dividend yield forever, Then since the principal has no maturity, I don't have to repay it. Annual preferred stock dividends are, by definition, dividends and not interest. Also, in times of crisis, the board of directors has the authority to suspend dividends. Therefore, in practice, leverage can be increased beyond 20% to as much as 30 to 40%. However, there is no credit risk as seen with bonds or margin loans. Financially, if you look now,
Various firms with financial traits like SPACs have emerged, and there appears to be a trend to imitate them. Isn't that right? 180 companies have so far
added Bitcoin to their balance sheets. There's been a huge increase in the last 6 months. I'm wondering if preferred stocks
are not being used, but rather companies are leveraging with actual debt. What do you think about these attempts in the market? Most companies use government bonds.
Instead of holding government bonds, they are buying Bitcoin, or instead of distributing cash flow as dividends or buying back their own shares, they are purchasing Bitcoin. In other words, they are increasing their capital base and reducing the company's credit risk. Some companies will try to issue Bitcoin-backed credit products. It could be a bond, a convertible bond, or a preferred stock. Our company will pioneer liquid preferred stock representing Bitcoin-backed credit. And companies like Meta Planet will probably issue preferred stock. And in Japan, they'll do it based on the yen. However, most other companies will just dip their toes into this market by simply expanding their capital base. And they won't go as far as to get into the business of issuing Bitcoin-backed credit products. How much leverage is there?
The Bitcoin we hold,
about 11% of it is in bonds, that is in the form of convertible bonds, and about 9% is in preferred stock. It's not a very large proportion. Currently, we hold about 7 trillion won, or $200 million worth of Bitcoin, and we have $800 million worth of convertible bonds, which will eventually be converted into stocks. More than half of them are already in the profit zone, more than half are profitable.
They are in the profit zone. They are in the profit zone.